So, was the last Alibaba earnings report game-changing? Yes and no. So I know that many of you actually clicked into this sort of earnings breakdown video because you guys are a little bit too lazy to go through the report yourself. Trust me, I've been there, I've done that. In the short run, it seems like a very convenient and smart way to quote-unquote analyze companies, but it will be detrimental to you in the long run. So if you're really serious about investing and also analyzing companies on your own, sitting yourself down for a few hours to go through the quarterly reports of the companies you own and their competitors are the bare minimum. So of course, I'm not telling you to stop watching all YouTube videos related to investing. If you do, I'm out of business. But you should take it as a form of reference rather than the only source of information. Investing is a craft to be honed, and there is no leveling up in investing. And it shouldn't just be restricted to a passive exercise of just consuming content. Besides, there were many a times where people called me out when I was wrong. So it shows that most of my viewers are thinking, and you know what? I appreciate that. So you know what else I will appreciate? Liking that smash button, of course, so don't hesitate. So long story short, it's a mixed bag report. I think for those of you who have been following Alibaba for quite some time now, know that there were not much expectations for the company to perform anymore. Especially after Tencent's recent earnings report, which grew by a, yes, 0%. We all kinda knew that Alibaba is next in line on the chopping block. Now, the interesting thing was that despite producing a subpar earnings, the stock rallied up by 15%. What? Whereas when you compare all these big tech companies with their American counterparts, they delivered close to perfect results. Yet, the stock price continues trading downwards or even traded sideways. So this is why valuation matters. In other words, pricing in future expectations. So for China companies specifically, I think we know that expectations are right in the gutter. Valuations are also in the dumpster. Even prior to the earnings result, street consensus were revised again and again. Not upwards by the way, but downwards. Now, when you see headlines like this, you know that the earnings wasn't that bad, right? Wrong. The phrasing of headlines are very much influenced by the movements of the stock price after the earnings report. You see, words such as resilient Q4 and quarterly earnings and revenues beat because the stock went up. If the stock tanked for another 15%, you'll see headlines like, hey, it's the slowest growth of cloud business ever since its founding. Or, China's zero COVID strategy weighs heavily on growth and earnings. So I think I can start applying for a journalism-related internship soon. But that's besides the point. I'm still here on YouTube. So I think you came in for honest opinions. And here they are. 9% year-on-year growth is weak for a tech company, especially if you compare them to their American counterparts. However, if you actually compare it to its Chinese counterparts, I don't think Alibaba necessarily posted bad results. In fact, I think the resiliency of the business stands out from its peers. It can also be argued that the macro conditions and challenges are vastly different in both China and the United States. So we have to keep in mind that particular context. Now, I'll try to break the video up into two parts. I'll first talk about the good and the bad of the earnings report and maybe a simple conclusion at the end. Of course, you shouldn't trust me totally. So if you want to seek out for an alternative opinion on this recent Alibaba report, Seeking Alpha is probably one of the better platforms out there for you to solicit investment research and different analysis of different companies. Currently, they are running a 50% promotion if you use my link in the description box down below. It's $180 for an annual subscription compared to $30 a month. You get access to the track record of the different writers and their entire thought process. In fact, you can compare them against mine and you can make a much more informed decision. There is also a 14 days free trial to it, so you can sign up using the link below. So first things first, the recent quarter also marks the end of Alibaba's financial year. Do you know what this means? It means that in the subsequent few months, the SEC, which is the Securities Exchange Commission, will be including Alibaba into the provisional list of the HEFCA Act. And we'll see a multitude of different headline scares around how Alibaba is going to be delisted soon. So do brace yourself for that. Don't say I didn't warn you. Anyway, let's talk about things with more substance. So this financial year 2022 report encompasses the period from April 2021 to March 2022. So the recent lockdown event should technically only affect the recent quarter's report because it really became an issue only in March of 2022. Now, we all know what happened in the bulk of 2021. Crackdowns, and more crackdowns. At least, that's the story that we are fed with. how draconian and evil the Chinese government is. So, what's the actual impact on the business itself? Alibaba grew their revenue 19% for the full year. I guess they could have grown by 40% without government intervention. Who knows? I don't know about you, but I'm perfectly fine with a top line growth of 19%. I don't exactly know how much growth other people are looking for right now. Maybe 30 or even 40%. Now, with a business running on network effect, your biggest moat is your network. Duh. Alibaba managed to secure their goal of hitting 1 billion domestic annual active consumers for its China market alone. And if you look at their total AAC comparing to last year, they grew that number by 15.6%. 15.6% on a 1 billion customer base. Dying company, they say. I think people have really forgotten that Alibaba is still a growth company, although maybe not growing as rapidly as the last decade, posting 30-40% year on year. But it is kind of far from dying. Interestingly enough, I think the shareholders of Alibaba have pivoted from largely being growth investors to now people trying to bargain hunt, especially for those that don't mind the quote-unquote China risk. So if we were to zoom into the quarter specifically, the main driver for the stark jump in stock price was really both the top and bottom line beat. Essentially, street consensus think that Alibaba's Q4 results will suck, but it was considered quote-unquote okay, I guess. So revenue grew by 9% and it was largely lifted by the 8% year-on-year growth of its China commerce section alone. Because let's not forget, the core commerce section still makes up the bulk of its earnings, sitting at 69%. What a nice number. So for those of you who followed me on Twitter, in this tweet back in November 2021, I expounded my thoughts on the many concerns regarding CMR, which stands for Customer Management Revenue. And if you were to look back in the December 21 quarter, CMR was actually negative 1%. And that was when everybody jumped up and passed the judgment that this is going to be a dying business. And we are just at the start of the curve of how regulations are going to kill this golden goose of a business. So like I shared in the tweet, I think the pressure on CMR numbers will only be transitory and only time will tell who is on the right side of the curve. Also, throughout the earnings call, you can understand that there were two key areas of focus for senior management: optimizing cost structure and heavy reinvestments back into its business. Hence, they are guiding towards a higher capex level for both the cloud infrastructure and also the logistics networks to further consolidate their economic moat. So there are many clear signs of capital discipline and retaining of financial integrity, such as the huge reduction in share-based compensation from 50 billion renminbi to 25 billion. Unlike many other companies that are constantly printing shares, they are also increasing the velocity of share buybacks, where they did a total of $3.4 billion worth of share buybacks and are left with 12 billion out of the authorized 25 billion. So due to the macro slowdown in China, they have also cut back in headcount and became a lot more prudent in terms of managing their cash balances and also in terms of recruiting talents into the company. So moving on to the horrendous part of the report itself, EPS numbers were total rubbish. Negative 205% year on year. What kind of results is this? Probably worse than Luckin Coffee. At least Luckin Coffee bothered to fix their financial statements. Just a joke by the way, certainly hope that Alibaba is not fixing the three statements. So even if we were to adjust the numbers to non-GAAP measures, earnings per share was still down by 23%. The huge discrepancy, negative 23% versus negative 205%, was largely due to the write-down in equity value in their publicly traded companies. So this is very much so like Berkshire Hathaway, where they abide by the mark-to-market accounting framework. And when the market is bad, like this time round, it flows to their bottom line, showing such a huge income reduction. So the most concerning part to me was actually the huge hit on free cash flow numbers. So if you were to look at the operating cash flow, they experienced a negative 38% year-on-year drawdown, and the explanation provided was a decrease in profitability and the remaining fine levied because of the anti-monopoly saga. So the increasing capex guided by Toby, who is the CFO of Alibaba, is understandable because of the trajectory and the game plan of the business itself. But the decrease in top-line operating cash flow before taking out capex still seems to be impaired by a large extent. So this warrants a revisiting of the entire DCF model for the company due to the volatile nature of such a huge impairment to cash flows, which was probably not accounted for in the first place. So we will definitely need more time to observe the free cash flow number to see whether it's a permanent impairment or will it normalize back again in the coming quarters. So EBITDA margins continue to fall for both China and international commerce as they seek to penetrate into other markets and also expand their value proposition, which is mostly in the lower margins region. So this margin compression exercise cannot go on forever as well. So it is your judgment as an investor to understand what the adequate margin for the longer term would be and make your projection from there on. Next, the international commerce segment grew at a lackluster pace, where international retail grew by just only 4% year on year. They cited many reasons, but they feel very much so like excuses, ranging from the depreciation of the renminbi and the ongoing impact of the new VAT rules in EU, and also, last but not least, the Russian-Ukraine conflict. Because clearly, the next few closest competitors like Sea Limited Shopee was somehow immune by those said factors and still managed to grow faster than Lazada or Trendyol, when Shopee has a much larger base to begin with. So you can't really be expecting to yield a different result by doing the same thing over and over again. And this is just a plea from a small shareholder. Lastly, Ali Cloud's growth came in on the softer side. However, if you were to look at it horizontally, Tencent's fintech and cloud segment grew by only 10%, while Baidu grew its AI cloud segment by 35%. Comparatively, Baidu posted spectacular results, while Tencent and Alibaba were just meh. However, I do have a level of skepticism on Baidu's cloud growth, and I'm speculating on a very strong internal reliance on their personal cloud infrastructure for some of their own other business segments, rather than an organic growth to its cloud business. So I'm actually leaning towards an overall weaker trend of cloud adoption in China by and large. And this issue should be elevated over time, fingers crossed. So Ali Cloud still remains the dominant player in the market itself. All in all, there were both pleasant surprises as well as sprinkles of disappointment littered throughout the entire report itself. But purely because of the low expectations of Wall Street, it was an easy beat. The tricky part about the current valuation of Chinese companies today is really the question of how much is exactly priced in. The simple answer, quite a fair bit. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!